morning, everyone. Welcome to NICAR CRE Broker Forum. We have this once a month. It gives us an opportunity to go over hot topics in commercial real estate. We can have questions and answers with experts. And then afterwards, we do have a networking session where that portion is not recorded, but it gives everyone an opportunity to advertise their number one priority. Whether you have listings, it could be buyers, sellers, landlords, tenants, whatever you got. Or if you're just here to learn more about commercials or what deals are happening, this is the place. So you are welcome to put your information in the chat. We do save the chat at the end. And so if you said who was on that and you didn't save the chat, you can always contact us. We are trying to, I'm sort of behind in this, but we are trying to develop a system with the needs and wants in a spreadsheet that's accessible so we can go look at that at a later date. I also want to mention some upcoming events. So we will be coordinating with IR. Let's see, this is April. I can't even remember what May is right now. But in June, we do have Intersect Illinois, where we're going to go over ways that you could sell Illinois. So I'm not an Illinois naysayer. And I, think that there are so many benefits, but there are actually other people who think that there are problems with our state. So just trying to sell some of the benefits of our state. That will be on in June, coordinated with IR. I also have coordinated in August doing international 1031s, because a lot of people know about 1031 in the US, but they don't know that you could do it internationally too. So you can't go from US to foreign or foreign to US, but you can't go foreign to foreign. It's more complicated, but there is a process. So I have someone speaking to that in August. So today we are going to have Vivian Malli present for us. She is the expert in lending, commercial lending, and talking about some of the common loan pitfalls that can kill deals and how we can avoid them. So Vivian, if you could tell us a little bit about yourself and enlighten us.
Yeah. Hi, I'm Vivian. Hold on, let me see how I can get this. Okay. I'm Vivian Juan Malli, and I was formerly in multifamily on the owner-operator side. I oversaw a staff of 80 folks who managed properties, 11 assets that we had that comprised 5,600 units in Illinois, Texas, and Florida, as well as England. So we had value-add projects, we had ground-up construction, and then just older properties that were cash flowing. So I was previously with NAI Hiffman as well as a commercial real estate broker, and I covered a wide array of different types of commercial deals. And I migrated into lending mainly because my clients kept asking me for financing and they needed help. So I do all sorts of creative financing as well as conventional loans, bridge loans, rehab, working capital, portfolio loans, and new construction. So that's a little bit about me, but you came here to talk about basically what kills deals. So I wanted to kind of do an overview of the current market. So where the market stands now, we're going to have over $1 trillion in commercial real estate debt that's going to mature. What does that mean? Those loans are going to expire, and the current property owners may not be able to refinance, mainly because maybe they have falling rent rolls, maybe there's just stricter debt financing available, and they're not going to be able to meet those criteria. So in office, hotel and motel, and industrial, we're going to see a lot of that those loans expiring in the next 2 years, and that's going to create some potential distress sales where owners are going to have to they're going to have to sell or do something else in terms of ownership because they won't be able to afford the refinance or qualify for them. So that's going to create a lot of volatility in the market. And smaller banks in particular are going to be under pressure. So this is going to create an interesting environment where we have lenders being pinched as well as property owners. So it's going to make the financing quite more interesting or problematic. however you view it. But why does this matter? Because 20% of commercial real estate contracts actually, this is based on a title company's overview of 6,000 transactions. 20% of those contracts were terminated at some point. And so they didn't make it through. Commercial is so different from residential. Every deal is unique. And that is just so important to emphasize, because it's not like you can get a pre-approval for a home loan. With a commercial deal, it's going to be a combination of the deal itself, the building, what it's going to be used for, and then the strength of the borrower, net worth, liquidity, and experience. So a lot of the things I'm going to be talking about are 90% preventable. Some of them you can't, but a lot of them you can. So hopefully that means a lot of what would have been 20% failure rate is actually going to be more deals in your pocket. So the number one pitfall is going to be incomplete or inaccurate property financials. So this applies especially if you're selling a property that is, fully occupied. It's really important to have the rent rolls updated, that they're accurate, the profit and loss statement or tax returns. Somebody had sent me one that was from 2024, and I'm like, we're in 2025. So it needs to be current, like within 60 days. And that's a requirement for all lenders. Also, if you have a pro forma in your offering memorandum, and it's overstated in terms of income or understated with expenses, we're going to find out. And the underwriters with the lenders are going to make sure that they get everything verified. And those documents for income as well as expenses are going to be used by the appraiser. So if we don't have accurate information, it actually creates major problems for the appraisal. So this is related to pitfall number 1, which was about the documents, financial documents. So somebody might say, our building's worth $2 million, or I want $2 million, but that doesn't mean that the lender is going to agree that it's worth that much. So the appraisals are going to really set the lending limits, because the lenders are not going to lend money on something that doesn't have the appropriate market value. They just won't. And if there is a gap between the appraisal and then the purchase price, the buyers are going to have to come up with a difference. So that pretty much will wind up with a dead deal for most, because a lot of times people are not factoring that in. I dealt with a very difficult seller who, this also applies to business valuation too. If there's a combination of selling the business as well as the property, the business has to be valued also depending on the financials. So if the financials are inaccurate also, we're not telling the full story, we're going to have an issue. I had this happen with a daycare, and the seller was like, well, it shouldn't matter what my financials are. I'm going to be retiring. And I'm like, you're showing declining revenue. So your business is not worth as much as you think it is, because you've had declining revenue for the last 18 months. So I think it's the reason why I want to go over this is about setting proper expectations, because if you don't set proper expectations, you're going to have a dead deal, because either the seller or the buyer is going to face an obstacle that is just insurmountable for them, whether that's more emotional or it's like a financial reality. So it involves, we need to reset some expectations, and part of that is making sure we avoid these pitfalls. So pitfall number 3, this is pretty common, an unqualified or unprepared buyer. So one of the big things is that if they don't have a business plan, like we need a pro forma for whatever they're going to buy, whether that means it's a fully occupied property, or let's say there's a retail center with a 50% vacancy or an upcoming vacancy that's going to expire in a year. If they don't have a business plan, it's not going to work. There could be credit issues. Maybe their score is in the low 600s or the 500s, or maybe they have too much debt. So that's going to be a problem too. Or if their liquidity is really low. Usually liquidity, we need about anywhere from 6 months to 12 months of operational expenses in liquidity for the buyer, or weak documentation. They don't have personal tax returns, or they didn't fill out their complete personal financial statement. So this is a biggie, because if the buyer isn't willing to do the necessary paperwork, we have no deal. Underwriters will not lend money on a hope and a prayer. That's just not how it works. So number 4, zoning incompatibility. So this is probably the most overlooked deal killer in commercial real estate. So let's just give you an example. Let's say there are some sellers who own 50 acres of farmland and they're ready to sell. And then there's a hospital that wants to build a new medical facility in the town. But the problem is it's zoned agricultural and the hospital needs it to be commercial. Now, in this particular real life scenario, the legal team had attended multiple town meetings, and the community was pushing back on having such a large hospital in their small town, and the rezoning request was denied. It's just kind of crazy. But the deal fell through because they couldn't get the zoning. But this could happen for a number of other situations. This can happen like for a soccer facility that is trying to buy a warehouse, and they're going through a special use permit, but for one reason or another, they're not able to get the rezoning or the special use permit. So there's just a lot of issues, and it depends on the business, but it's just really important to make sure that you check. But even on like ordinary deals, it's just really important to not assume and to make sure that the buyer or you call the village to make sure that they're going to have a permitted use. Because I'm working on a deal right now, and it's not a huge deal in terms of zoning, but I need to send the zoning guidelines to the lender because the underwriter has got to have it as a checklist. So it's just important to make sure you have that information. Number 5, underestimated renovation costs. So I have a deal where this is their 4th property. We're under contract, but it's their 4th property. We had 3 other deals that went under contract and failed because of underestimated renovation costs. And there were repairs that needed to be done, problems that we found with like the facade and the brick, and then there was water damage. And so what looked like a building that wouldn't require much renovation, like they thought it was going to be minor, wound up being $120,000. So that killed the deal. And you also want to make sure that they're going to be code compliant. So there's just a lot of different issues when it comes to estimating renovation costs. And you just want to make sure if you're the listing agent that you've understood what are the issues with the building. So this is super important so that you can communicate these things properly and upfront, because if the buyer has to discover it and it spends a lot of money, then you have a lot of real frustrations that will kill the deal. So, survey issues. Now, this is something that is required, just so that you know, surveys, typically the more recent, like Alta surveys are typically required to be 6 months or less. So if it's an older one, it could still work with underwriting, but it's not a guarantee. The newer the survey, the easier it is. So it's just important to note that the survey is critical because the lender is using it to make sure there are no issues with them having full ability to have be free of liability or have any easement conflicts, and also for the buyer to make sure that they can operate in the property. I had one survey, part of the parcel is in a floodplain. Thankfully, for this retail center, the floodplain only touched the parking lot, but it was still a concern. And because we were able to talk to the underwriter, they're like, okay, the building itself is not in the floodplain, but the parking lot is, and it was only like it was only going to affect about 15 cars. So, but still, those are things that are important to note. And if you can get ahead of them, especially for larger properties, larger parcels, it's important to uncover those so that you don't have issues in your deal when you're under contract. And besides, if there happen to be certain floodplain issues or any other requirements that where the village may require that you have a certain amount of detention, like water detention for a certain amount of acreage, then it's important. That's important to know as well, because that affects usability and what the footprint is, like the usable footprint of the parcel could be. So just want to point that out, because that can really affect the timing of your deal and whether or not you can move forward for that particular buyer or use. So pitfall number 7, underestimating timeline requirements. A lot of kind of mom and pop owners of property, whether it's a small retail facility or maybe land, they don't understand some of the timeline requirements. So it's going to be important to educate your clients, just because I've had to do this a number of times with listing agents that were residential and didn't understand the differences between a commercial and a residential deal. But even with different commercial brokers that I've worked with, some of it is just they didn't understand because they had not done this type of deal before. So there's a lot of pressure for sellers to and their attorneys to say, hey, we want it to close at X date. We're going to close in 45 days. And I'm like, whoa, this buyer is applying for an SBA loan. And SBA loans are going to fund in 60 to 90 days. So we can't do a 45-day. Or like they say, oh, we want to stipulate that it's going to be 20% down. But on an SBA loan, they can go as little as 10% or even less. So we want to make sure that we're not inserting things in the contract that are actually creating problems for the deal. And part of that is just having a conversation with the lender or mortgage broker that's involved. I try to make sure I communicate with all parties, because we just want to make sure we have proper expectations. So I wind up talking to the attorneys regularly and keeping everybody abreast on a weekly basis about where we are in the loan process. So due diligence for commercial appraisals can take 3, sometimes 4 weeks. Of course, and for environmental review, if you have a phase 1 that leads into a phase 2, then that really throws things for a loop, and it will definitely lengthen the process if that deal still proceeds forward, because we don't know what that phase 2 is going to look like. And then on top of that, we still have underwriting. So underwriting is happening in the background, and that creates another layer of complexity that needs to be addressed. So it's just important to understand that in general, commercial loans are going to take about 60 days to close, but sometimes 3 months or longer. If it's a HUD deal, like let's say there's low income housing, you're going to be looking at 9 months to 12 months. So it's like a year. And then if it's like a multifamily property with agency loans like Fannie Mae or Freddie Mac, you're going to be looking at 3 to 4 months, especially now with a lot of the changes in the federal government. Things are going to take longer. Fortunately, SBA is still pretty robust in terms of like operating as normal. So those don't take as long as like we get all the paperwork when it's needed. So, but I just wanted to touch on that, because that's really more about making sure everybody's understanding why the time, like what timelines are involved, and me making sure that I can communicate with everybody. So, and oftentimes that's going to just revolve around a lot of conversations with attorneys, both seller and buyer's attorneys, and then the agents themselves, the commercial brokers involved. So, just want to touch on that just so that people have a realistic assessment of how timelines work on commercial financing. So, all right. Pitfall number 8, wrong lender for the deal. I had to rescue a deal 2 days before it was scheduled to close on its original closing date because the lender fell through. And it was just the wrong lender. They couldn't fund this deal because they had a very narrow set of criteria. Some lenders won't finance restaurants, gas stations, or cannabis-related businesses. Some might reach their limit of funding restaurants. They're like, oh, we're too heavy in restaurants right now. We're supposed to peel back. So even if you've closed with them before, their credit criteria may have changed. So that happens, especially if there are different types of things happening in the market, or if their underwriting department is suddenly getting really busy with all sorts of deals. It can lengthen the underwriting process or just prevent you from funding the deal. So it's just important to work with a commercial mortgage broker like me, because if you work with a direct lender, you're kind of done with that lending institution for the deal. But I have access to over 750 lenders. We've vetted them, and we have their underwriting criteria, and we have their live pricing. So we know which ones are going to be in the market for certain types of deals. And then that way you can avoid wasting precious time that eats up, the time remaining on your deal that's under contract. So, okay, how to avoid these pitfalls? You want to partner early. So I work with a lot of commercial brokers in terms of pre-qualifying their prospective buyers. And that may even mean pre-qualifying any prospective tenants for a space where the landlord isn't willing to fund tenant improvements. So we can do working capital loans where we can fund the tenant improvements if the landlord is not willing to do so, or if the tenant doesn't have the credit. So you want to pre-qualify everything. And because in commercial financing, it's not just about the buyer, it's also about the deal. What is the property going to be purchased for? Or what is its ideal use? So for example, if it's a second generation restaurant and you're like, okay, this thing has been dark, but there's still a lot of workable, usable equipment. Let's factor in $200,000 for renovations or anything for a new restaurant. And then we'll put it together like a fictional buyer scenario. And then I can present you with different options to see what kind of financing is available for the ideal user. And then from there, you can craft who your target market will be. So when it comes to having proof of funds, then I can give you a calculation of like, oh, it's going to be X amount because we need to show that they have enough reserves and that they have enough to cover closing costs and the down payment. So also making sure that you have enough documentation, if you're on the listing side, making sure you have all the seller's financials prepared. Like let's say it's a business and a property sale, make sure you have all of those last 3 years of profit and loss statements, tax returns. Those are going to be essential. Or if it's just the building itself, then making sure you have a recent ALTA survey and just uncover any other issues with the building. It's just about being able to set realistic expectations so that you can proceed pretty smoothly with your deal. And then I wanted to cover, this was something I did cover, was the strategy about how we use the right loan strategy. So it was a small industrial warehouse. We flipped it to an SBA, but I had to discuss this with the listing agent as well as the seller who didn't understand what an SBA loan was. And so now we're on track to close in 8 weeks versus like having that deal almost die because they had the wrong lender in place and the buyer didn't know who else to turn to. So fortunately, the buyer's agent tapped me and we were able to restructure it so that this deal will close in the next week or so. And why choose us? We have like close to 100,000 loan programs available. Like each lender will have different types of programs, and we have a platform that enables us to actually take the deal scenario and see what options are available in the marketplace. That makes it efficient for us to find the right lenders who are going to consider this loan realistically. And we can do that for a wide variety of asset classes, whether that's office, industrial, retail, special use like entertainment, hospitality, as well as ground up development and vertical and horizontal development for new construction. So let's see here. So going back to loan expirations and what they mean for your business, there's going to be more transactions primarily due to distressed situations for sellers. So and there are going to be opportunistic buyers who are going to be looking for those deals. So it's important to know and understand financing so that you can be on the leading edge of those deals and hopefully increase your business. So here's my contact information. I'd like to open it up to any questions.
Thank you very much, Vivian. I have a few questions. If anyone else has questions, please use the raise hand reaction button at the bottom, and I'll just go in the order that you have questions. And I have my own list. So I'll start with, when you were talking about in the beginning to have all your paperwork in order, your documents, the P&Ls, the rent roll, how strict is the criteria if the loan to value is low? Like say the buyer is putting forth 50% of the funds. Are you still expecting to have everything in order?
It kind of depends on the purpose. Give me more detail about like.
Well, I'm just thinking of like one of the clients I have. One of them, I have multifamily, and they're behind in giving me P&Ls and whatever. And so for a lender to even like look at the deal, I still just have 2024. I don't have, I even have later than that. They said, well, we'll give you all the P&Ls if it sells. They're not highly motivated at the moment. But my point is, if a buyer comes in and says, well, I know based on the market rents that this is a good deal, like you don't need to give me even the P&Ls for me to know what this building can perform at.
Right. Multifamily is a little different. It depends on the unit size. How big is how many units are in this property?
13.
13. So they'll want to see the most updated rent roll. Oftentimes, if they are not able to produce it, sometimes it's just a conversation. I've spoken to sellers where I talk to them and I say, I just need like 10 or 15 minutes of your time, and I'd like to send you this spreadsheet. We're going to go over it. I'm just going to input the numbers for you. So a lot of brokers want to have this like all ready to go, at least commercial lenders. But I know for like, especially properties that are under 50 units, a lot of these sellers are not sophisticated. They don't have like property management software. They don't have this. So, I have the spreadsheets, and oftentimes it's just like, okay, can we just like go through this for 15 minutes? And I did this with somebody, and they were like, oh, that wasn't that hard. I'm like, no, it wasn't. I just had to ask you the questions. And so some of it is just like, hey, what about in January and February? You're not going to have landscaping, but you have snow removal. How much did you spend in January and February? Do you remember? And they're like, oh yeah, it's like this. So those are like, if you have problems with getting financials, especially on multifamily, I have those spreadsheets, and sometimes it's just a conversation so that they don't have to do it, because in their mind, they're like, I don't want to provide I don't know how to do it or whatever. But just a simple conversation can get me the information so I can then put it in for them. And right. I mean, to me, it's worth it to make the deal move forward.
Mm-hmm. Well, I agree. Sometimes they don't agree or they don't have the time.
Or they don't have, but I think a lot of it is just more like they're intimidated by when people ask for it. It sounds so fancy, profit and loss statement. No, I just need to know your income and your expenses. So can I just talk to you for 15 minutes? Or sometimes I will send questions of what I need filled in, and then that's good enough. And so for multifamily, especially under 50 units, you're going to see that, especially if it's under 20. This is much more common. They don't have a P&L. They don't have trailing 12 months of expenses. It's a pretty standard thing to ask, but I mean, many of these owners don't have that.
Yeah. And we did have this complication with this property originally because actually they did have a management company, but it was poorly managed and it just became a mess. So then they took it over, but then they're not keeping up with the accounting. I mean, they're collecting rents. The NOI is there. Right. They're just not doing their...
I've seen pro formas from property management companies that are just laughable. but
Yeah.
that's not their priority. So what I do is I try to reconstruct it in a way that is going to be acceptable to a lender. And so I just try to collect as much of that information, but I'm the kind of person that will do that because I want to develop relationships with people in the local marketplace, and I know how to get deals done. So if that's the impediment, I will make it no longer an obstacle. I will create that for them. And whether that's creating the pro forma for the new business owner, for the seller, whatever that might be, I just do it because that's what's necessary to move the deal forward and get it closed.
Thank you. Dr. Mustafa, you have a question? Oh, you're muted there.
Yes, I have. Well, the first question, of course, I do a lot of multifamily. And so the last 3 or 4 deals I try to do in multifamily, some of the emphasis was on management. And we have also found out, well, management is the leading cause of why multifamily will fail. Can you give us any underlying guideline or what the management should look like?
Sure.
for-
So property
for-
management, especially depending on the area that you purchase in. So let's say you buy in the south side of Chicago, and the property management firm is going to be very important because those are more challenging properties.
I would like those recommendations of who you work with.
So
Okay, well,
the
I
property-
have to interrupt here. Why
Sure.
the south side of Chicago?
because the lenders are looking at it and they're saying those are high crime and violent areas, and unlike like if you were to buy a home, you can't apply those restrictions, but a commercial lender can. And so for the lenders that are willing to lend in those areas, and some lenders have like said no to Cook County. I'm like, you're not going to lend in Cook County. They're like, no. And the ones who are willing to do so and lend in higher crime areas are saying, we want to know who the property management firm is. They want the bio. It's helpful if they actually know them. In one deal, they were friends. They were friends with a property management firm. So I was like, whew, that's good. But it is especially important in challenging areas where there's high crime to have a property management firm that has experience with, and they're going to want to check which properties they're currently managing. So they'll do a deeper dive into the identity of the property management firm, the experience, and how well they're doing. So yes, that matters, especially in those types of areas. If it's like where it's not as high crime, it's not as important because they feel that it's not, the identity of the property management firm is not going to be as critical in those areas, but it can lead to huge losses and a potential default for the buyer if they don't have the right property management team in place. And for a lot of buyers of Southside properties, I would say a good chunk of them, like maybe a quarter at least, are out-of-state absentee landlords. So they're relying on the property management firm to manage, right? Let's say they only fly in every other week or maybe once a month or even less. It becomes even more critical. But I mean, I've been seeing a lot of buyers from California buying up or looking at property in the South Side, or they might be from a different state, but in like another state in the Midwest or something like that. But I've been seeing a lot of buyers from higher priced markets who are looking at Chicago as like a value town, right? Because they're in their mind, they're like, wow, these properties are cheap compared to where I come from. And so you're going to see that become an issue in terms of the identity of the property management firm.
Okay, that almost sounds like a legal issue too. But now, far as the underwriting is concerned, property management fee across the nation, it looks like it's between 8 and 9%. So if somebody put in 10% as their management fee or higher, would that be an underwriting issue?
Not necessarily. I mean, it's the underwriting issue is going to be more about what is net operating income going to look like. is net operating income sufficient enough to make the deal work? Because it depends on the debt service coverage ratio. So if the net operating income is going to fall within the right guidelines, at least 25% above the debt service, above the mortgage payment, then you're going to be good. So if it's not negatively affecting the net operating income, then it shouldn't be an issue.
So if I put in there 15%, no problem.
They're gonna wonder why, but it might be offsetting some other expenses. It might be offsetting marketing, and it just has to make sense.
And I was actually going to ask about that, the debt service coverage ratio, like what you're seeing. Is it typically 1.2? Where are you at?
Minimum 1.2 usually. You can still do deals at 1.0, but if you have deals like that, you're going to have a higher interest rate. They're going to be with more specialty lenders that are comfortable with that. If there's no DSCR, then you're looking at a bridge loan. So vacant properties, I remember there was this one commercial broker that was offended that I wouldn't base the financing off the pro forma. And I'm like, the pro forma can only do so much, right? The lenders want to lend on actuals, not the pro forma. So I don't know why he was so offended, but it's just how lenders behave. So I'm not saying his listing was ugly. I'm just saying, like, based on the actuals, which is what is more likely to happen instead of the pro forma, where, yeah, you could potentially raise rents and potentially like turn these apartments and get, yeah, sure, like in 3 months, sure, whatever. That's not realistic. That's not how lenders think. They think very conservatively. So when I sent him a figure for how much it would be and then what I thought were the probable lending scenarios, he was totally offended. But when I give information, it's about what you can realistically expect to get. So I'm very
on that point, so you would talk about restaurants, right? And I have a restaurant that was dark. Now they're kind of reopening it, but we don't have any recent numbers. I mean, we have some because they just opened, but it went dark during the pandemic. And so we can provide seller financing. That is an option. But how would you deal with a restaurant that's been dark since the pandemic? And we kind of know pro forma what it could make, but would you lend on it at all, or maybe?
Yeah, that really depends on the strength of the buyer, because it's understandable that went dark. Are they selling the restaurant?
The business plus the real estate.
Okay. It'll really depend on the strength of the buyer. So, and what kind of restaurant is it? Like a breakfast place, or what kind?
It's really more of a bar. There is restaurant space. It's a bar, a lounge, beer garden, and restaurant. And actually, the pro forma looks very good because there's gaming, and on the conservative side, you could make 20 grand net just from the gaming on the conservative side.
So the way this deal is going to work is to make sure you have a buyer who is experienced in running that and already has well-performed, like other locations that are performing well. So that will not be an issue for a strong buyer. If you have a prospective buyer that is new to the restaurant industry, has never done this before, has mediocre credit and liquidity, it's not going to be very financeable. It might get financed like on a bridge loan, but I wouldn't have strong hopes for that kind of buyer. So it's very buyer dependent, because the operator, the new operator, it'll have to ride on their experience and previous succce. So usually,
if you know someone that bought restaurants, this is actually a pretty good deal. So contact me afterwards.
Oh, okay. I actually work with a restaurant consultant who he might know of some people. So, yeah. So in that scenario, it's going to be dependent on the experience and success of the new buyer, as well as net worth and liquidity. So as long as those things are in place, there's not going to be an issue.
Awesome. Thank you. Steve, go ahead.
So I have to come out of the closet here. I am not a commercial real estate professional. Well, I am, but I'm more of a business broker. Vivian, I didn't hear you say at all that you do business loans separate.
I do working capital. We can do business acquisitions.
You do?
Yeah, business acquisitions and
Okay.
Comloan doesn't specialize in that. They do commercial real estate, like commercial mortgages. So, but I work with all sorts of business owners. So
Okay.
as a result of people constantly asking me, that has become something that I've done. And so if you have, I'll give you a scenario here. This was a deal that they're still contemplating, but he wants to buy a manufacturing business. It's 6 or 7 million. And he was having a hard time finding somebody who would do the deal, mainly because he wants to run it through SBA. And SBA has a limit of 5 million. Oops, sorry. 5 million. And the thing is that we have those caps, but there are certain lenders that are willing to lend on top of the SBA loan. So those are like multi-layered financing. And so we can do those deals, especially when we're talking about a business acquisition. It may or may not involve real estate. So I can definitely help with those. Actually, I spoke to a firm yesterday that needs expansion financing, and they also need some cash flow from their accounts receivables. So we can do accounts receivables like lending, as well as equipment financing. So it just depends on what it is. I have a lot of different needs that business owners come to me for. And there's a wide range, but I can definitely help with that.
So I have a follow-up. Is that all right?
Yeah, absolutely.
I'm like a reporter in the White House. I got multiple part questions. Okay. So given that you do business loans, would you do a quote pre-approval term sheet? So if I was to give you a business summary and outlined all the financials over the past 3 years and at an asking price, do you do a pre-approval? Like I have another lending broker that I work with that will give pre-approval term sheets. And of course, it's all contingent on the qualifications of the buyers along the lines of what you're saying. But is that something your company does as well?
So at Comloan, we can provide pre-qualification certificates for property purchases. When it comes to other types of financing, I can't give a pre-approval or a pre-qualification, but what I can do is reach out to my lending partners and provide you with term sheets directly from those lenders.
Yeah. And then I'm sorry, I got another part to this question. So how closely do you work with the real estate professionals out there in terms of prepping whatever property they have so that it won't meet the pitfall? I was ready to cancel my Minnesota real estate licensing exam based on all your pitfalls, but I've changed my mind since. But my point being, is this something you can work with, like the Teresas and the Bill Catons of the world, to kind of say, hey, I'm reviewing this, be sure to be on the lookout for that? And that'll be the end of my questions for today.
Yeah, absolutely. I do that on a regular basis. It just depends on the scenario. So, and some sellers are more open than others. So it really also depends on, if they wish to, open up a little bit more. But I mean, it really depends on the personalities and what they're willing to do. But I'm very flexible and I like to see deals close. So, I'm happy to help where possible.
Thank you, Vivian. Bill.
So I'm like Steve. I have about 5 multi-layer questions, but I'll try to get it down to 1 or 2. Working with a current gentleman who's been a builder, GC on many projects. Okay, he's starting out to be his own developer on a smaller project, 5 acres. Would you work with him to put together, his pro forma?
Absolutely.
he's working on and creating his own spreadsheets, and I'm telling him that that's not going to work for the lenders. He needs to have a formalized performer with tabs, in every one part of that. And part of this will be also pre-qualifying him. All right. So there's a range of what we can do with his 5 acres. We fortunately have an LOI right now from Children of America for a 10,000 square foot building. And that's a turnkey operation and guaranteed rents coming in. And we have the opportunity to do a standalone ice cream user on the site, and then a small strip center. That's probably going to be an $8 million project if we do it that way. He has this ambition to try to not do the standalone ice cream, but push them in line on a 4-story building, commercial first floor, 3 stories of market rate rentals, 35 units. That pushes the project to about 12 million. So I'm originally started working with him on the $8 million, and now he's, so grounding him a little bit, and he's saying that he has the investors, that he can put together to do this. So if I were to connect him with you, then you may be able to help him and figure this out.
Absolutely. I regularly help buyers, developers with business plans, resumes, like things that I know are going to be critical in terms of how the lenders are going to view them. I've had to redo resumes, business plans. I'm like, this is totally unrealistic. I've had to create different spreadsheets that are industry specific, one for an auto repair, because they don't know how to do it, or that's not their specialty. That's mine. So I know how the lenders are going to view it and what they want to see. So I just try to make sure that I structure the information that they have into a way that it's easy for the lender to digest and say, oh yeah, this is actually a great deal. That's what we want the lender to say, or multiple lenders to say, because then they have now many options instead of one or none. And so I think part of it is just understanding. You want to work with a mortgage broker that understands how to communicate that data, because that's what it is. It's just data. But sometimes it's just caught up in a conversation. We haven't formalized it or documented it. And all the multiple conversations that we're having between the sellers, the listing agents, and what the buyer could do with it, we have to transform that into something that's financeable. So that's what I do.
Okay. Second question is, I'm working in multifamily. I have sellers that have put together performance already, and I have and he's willing to sell these projects or JV them, and build them out. And I'm now looking at investors. So before I send his performance to investors and ruin that relationship for the equity, because we're looking probably at you tell me, are you doing a 70 or 75% loan on multifamily, LTC? What's your LTC for multifamily?
Sometimes it could be higher. Sometimes it could be 85.
You can go as high as 85?
You can, but it'll take a year to close.
Oh.
So the
we don't
lower
have
the
that
down payment, the higher the LTV, the more underwriting and the longer it will take. But the lower the loan to value, the easier the underwriting becomes.
Okay. So a 75 LTC is what?
That's gonna, takes 10, maybe 8 to 10 weeks to close, depending on the strength of the borrower.
90 days?
Yeah.
120? Okay.
Right. That's on the long end. But and that's just because normally anytime we have construction, we're waiting for a lot of the contractor's documents. So that may mean filling out an AIA, contractor qualification form. We need to have an itemized, we need to have the construction schedule. We need to have all the subcontractors listed. There's a lot more paperwork involved for construction projects. So that is part of why it takes a little bit longer to close, because we need to get all of the documents from the general contractor, the seller, as well as the buyer.
So if I bring, this will be my last layer like Steve, okay? So if I bring an investor into this multifamily project, okay, and this is a $23 million, $25 million project, and the investor brings the equity, right? Is there a requirement? I've seen some lenders saying that the investor then has to have 80% ownership of the project. And
It'll depend on the lender, but we definitely need their financials, because everybody's identity and financials have to be considered. So especially when there's an equity investor. So because they're footing the down payment. So
do you dictate then their ownership of the project, that it has to be a certain?
It's flexible. Like it depends on the lender. I've worked on some deals where there was very little experience in the actual buyer. She had the cash, but she lacked the experience. So they required the general contractor to be on the deal as a principal, but limited to 20%. And then she would buy them out upon completion of the project. So it was structured in a certain way to satisfy the lender, because she lacked experience.
Yeah.
So
this might be an unusual deal in that the investor will bring all the equity that the owner developer needs, but then he has to take one of her projects, 25 unit subdivision, as part of the deal. So you don't care about that. You don't care about the other part of the deal. You just care that she's bringing the equity and that her balance sheet will cover everything. Okay.
Yes. That's what lenders care about, because they just want to know that that person is going to has the net worth of the deal. So typically, like for most deals, let's say it's a $2 million project. I'm just using an example, that the person who's buying it should have at least a net worth of 2 million, but usually more, because they want to have 6 to 12 months of liquidity, post-closing liquidity. So they made the down payment and paid the closing costs, and and then they still have to have cash reserves to qualify, as well as the net worth. So, I mean, for that $23 million deal, they're probably going to want somebody who has a comparable net worth. It's just kind of how it goes. If somebody has significantly less worth, they're going to begin to wonder. And banks are not one to be, to take these things lightly. They're not like, oh yeah, we think that it'll be worth more, or they'll be worth more after this project is completed. No, that's not how it works. So typically it's a 1-to-1 ratio in terms of net worth and project value.
Thank you. Answered a lot of my questions. We will be talking.
Yeah, I know. She hit all the key buttons for all the listings I have. So for sure, I'm getting on the phone with you afterward between auto repair, multifamily, restaurant. This content was amazing. Super good content. I wish more people were here today, because you really have a lot of wealth of knowledge that you can share. And but it is going to be posted on the NICAR page, the CRE Broker Forum page, as well as it goes on YouTube. So it will be out there, and hopefully you'll get some questions following up that. So I'm going to close this out so we have a few minutes to network. I appreciate everyone coming on a regular basis and bringing forth ideas and different ways of doing real estate. Please put your information in the chat. We will save it. And if you have any presenters or would like to have content on a particular topic, please do reach out to me, Teresa Mueller of Trillium Real Estate. I'm at info@teresamueller.com, 630-715-9999. You could reach out anytime. I'd love to hear what your ideas are. And I hope to see you next month. Ciao for now.